Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have another Dutecast for you where I'm going to give you a solo report on a topic that caught my eye. Now this one takes a look at what is my favorite new ETF to launch this year and why I think it is both so great and so long overdue as well. But if you have any questions or comments, make sure to send them in to podcast@zacks.com, and don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my look at one of the best new ETFs of 2017 right after this. So we're right at the end of Q3 here in 2017, and I figured this is a great time to look back at some of the funds that have come out so far this year. Now, we've had a really good run in terms of launches, about 150 funds that have come out since January 1st. And yeah, there have been a whole lot of what I call Me Too products, where they basically take a concept that's already out there and just try and beat it in terms of price or just tweak it a little bit. And we saw that with BAR, which follows the gold market, a ton of ESG funds out there. And then a number of people are beefing up their ETF exposure from the mutual fund world, like Mason, Hartford, Franklin, to name a few. And that's really been a broad trend across the ETF world over not just this year, but the last couple of years as well. Now, moving beyond these Me Too funds, we have seen some interesting products targeting specific areas. Now, a couple of my favorites, OBOR, One Belt, One Road ETF from Crane Shares, targets China's geographic strategy in terms of restarting the Silk Road again. And of course, the great ticker MAGA for the Point Bridge GOP Stock Tracker ETF fund. And one of my other favorites, FNG, which we just had a podcast about, and I definitely recommend checking that for some additional information about the FANG stocks and what's going on in that area. But that's not really what I want to talk to you about today. Instead, I want to look at what is probably my favorite ETF to hit the market in a long time. And I'm really shocked that we didn't have this already. I mean, we've had funds targeting cybersecurity, palladium, even Pakistan make their debut long before this one, and that's really shocking to me. Now, the new fund I want to talk about is the First Trust Dow 30 Equal Weight ETF, ticker symbol EDOW. And as you might guess from the name, it tracks the Dow Jones Industrial Average, but in equal weight fashion. But before we get into why this is such a solid idea, we need to go over some basics of the regular Dow first. So the Dow began as 12 companies way back in the day, late 19th century basically, and only GE has survived to this day in the now 30 stock index. Now, investors can buy into this index with DJIA, one of the most popular ETFs out there, but the real thing to note is that the benchmark is price weighted. And you might not know this, but price weighting is a different way of weighting a particular index, and it's rarely used today. And the key thing to note is that companies that have higher stock prices actually receive a higher weight, regardless of how big the company is, how much revenue it has, any of those other factors. A lot of people don't realize that about the Dow, but it is what sets it apart from some of the other main benchmarks out there. And sure, this might have been fine back in the late 19th century when the benchmark was below 100, but is it really appropriate for benchmark over 22,000 with such a wide variation in stock prices between companies? I am sure we didn't see that back in the day, but we do see that right now with two companies that are in the Dow. Boeing is about $250 a share, and GE is about $25 a share. So as you might guess, Boeing in a price-weighted index makes up a lot more of the actual index and fund than GE. Now, you might say, is Boeing 10 times as big as GE? Well, no, GE is actually a bigger company by market cap. So to me, it doesn't make a whole lot of sense why Boeing has such a bigger allocation in the Dow Jones Index. And this price-weighted focus is why we didn't see Apple in the benchmark until they split back down to a reasonable level. By that, I mean Apple at $700 a share, give or take, before their split, is almost 3 times Boeing's current price, and that current price for Boeing puts the company at about 8% of the Dow. So you can imagine if Apple was 3 times as price-heavy as Boeing, how it would completely dominate the index, and that basically made it unaddable despite the obvious importance of Apple to the broader American economy. Now, that's also why you shouldn't hold your breath if you're looking for companies like Amazon or Priceline to get in the index. It's just not going to happen when they're over $1,000 a share or near that level. Now, the impact of this price-weighted focus is that instead of Apple, Microsoft, and Exxon at the top, these actually account for about 9.4% of the benchmark, even though they're the three biggest companies by market cap in the index. Instead, you get companies like Boeing, Goldman, and 3M dominating the index, as those are actually the three biggest components, even though they're not nearly as large as any of the companies I just listed. In fact, those three companies alone, once again, Boeing, Goldman Sachs, and 3M, make up about 20% of the total Dow Jones exposure. Meanwhile, the top 10 stocks in the index account for about half of the exposure. So what's the point of having a 30-stock index if 10 of the stocks account for half of the exposure and the bottom 10 actually account for a measly 15% of exposure? In fact, GE makes up less than 1% of the Dow Jones. You have to ask yourself, why is the company even in there? It's not really going to influence the price or movement of the Dow, at least at that small weight. Now, this sort of insanity is where the equal weight EDOW comes in. Now, EDOW puts about 3.3% in each of the 30 blue chip stocks, so no one is left behind and no one's leading the pack either. So a bottom 10% get about a third of the exposure, same with the other thirds as well. And so that gives you roughly double the allocation in the bottom 10 stocks as to what we see in DIA and the Dow index at large. Now, the downsides here are that the exposure is slightly tilted when you compare it to this more traditional Dow index. DIA is a bit more into industrials, while EDOW has a slightly higher tech and consumer staple weight. Additionally, EDOW has a higher average market cap and a bit higher dividend yield too. Interestingly, though, many sectors are relatively similar between the two overall, but it's really a difference of weighting among the individual companies that is the big key to the differences here. The equal weight keeps things in balance and ensures that some aren't completely forgotten, like we see with GE, or even companies like Cisco, Pfizer, and Intel, all of which have less than 1.5% allocations in the benchmark. The focus on the equal weight also reduces some of those bigger companies and gets them down to a more manageable level. No more do we see companies with weights over 6% in many cases. Instead, United Health, 3M, Goldman Sachs, and Boeing all see their weights cut in half in the equal weight benchmark. Now, there is one issue to note, and that is the fees. Fees are significantly higher for EDOW as compared to DIA. DIA has about 17 basis points a year in fees, while EDOW has 50 basis points a year in fees. Obviously, that's a rather sizable difference, but at least to me, I believe that you're getting a much better exposure profile with EDOW, especially when you compare it to DIA. So the bottom line here is that the Dow is a terrible index that was better served for a previous age in investing. To me, it's really a miracle of marketing that has become, and still is, such a popular benchmark for the average Joe investor out there. But fortunately for us now, EDOW exists. This new fund takes the solid idea of investing in just 30 blue chip companies from across the domestic economy, and it weights them equally. Now, say what you want about equal weighting, and I don't think it is always the best route to go down, but it makes a whole lot more sense in this case, especially when you compare it to something that bases weights on such an arbitrary statistic as share price. I just can't believe it took so long for someone to come up with this fund. All right, everyone, hope you enjoyed this solo Dutram report and my look at EDOW in greater detail. Make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future, and for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Dutram Report on iTunes, and if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @Eric Dutram, or leave us a comment over on Facebook too. But be on the lookout for a new edition of the Dutram Report each and every Thursday. But until then, for Zacks.com, I'm Eric Dutram.